I think there's a bigger upside in the owning financials right now. Because financials are benefiting from AI.
Okay.
So they're the second order beneficiaries. Plus, they're getting the green light to build on the blockchain, which could really make JPMorgan and Goldman's business models so much more profitable and change their multiples, expand them. So I think, yes, I'm still bullish on AI, but I actually think the financials are really one of the legs that drive us the next 12 to 24 months.
Now, interestingly, Tom Lee talks about financials, something we are going to cover in the episode today. But similar to the rest of the S&P, that industry in particular has been performing very well. We're talking big names like JPMorgan up 26% year to date, Bank of America up double digit, similar to others as we can note. And stepping to one side, he actually has his own ETF called the Granny Shots. Now, you may have heard this, you may not have. One thing we would say though is, if you are interested in looking at similar stocks to Tom Lee or want to own part of his ETF, the expense ratio is on the higher end at 0.75%, which when we would compare it to something like the QQQ, does sit a lot lower at 0.2. Now, you may be a big believer in Tom Lee, and he's actually been outperforming year to date, although he did start this fund in November last year, is up 17%, outperforming by quite a distance the S&P that's up 10 and even the QQQ that's up 11.6. And if you're interested to see the top 10 holdings, well, we can see number 1 Palo Alto Networks, American Express in number 2 and Google in number 3. Now, out of these top 10, we don't actually see any of the names that he specifically talked about in that interview, which was days ago. We're talking JP Morgan as well as Morgan Stanley, but we will cover them today to give you our own views. And just like he said, there is a lot of upside in his opinion because there are many avenues that these big banks, these financial institutions can move into that in his view could start to expand their multiples. And JP Morgan, as we've heard this year, are looking into the blockchain, something that could be a massive shift from where financial institutions currently sit. And there was even talks a few months ago about their own stable coin. It's also interesting to note they're not standing still as a bank. They've tested the world's first bank-leg tokenized value transfer in space, so definitely something to keep an eye on. And their overall business is performing very, very well, and that is regardless of what we are seeing in the economy. Probably makes sense given the company itself is up 36% in the last year. They're trading at a 52-week high, $303, and we note both Wall Street and Seek Alpha, like Tom Lee, believe this one is for consideration. Only thing we would say is both buy ratings are a bit on the weaker side, given it is out of 5. Now, if we were to look at their forward P ratio sitting at just below 16, that is above the 5-year average of 13, so we would say overvaluation. But bear in mind what Tom Lee is saying, he believes some of the larger financial institutions, their multiples will expand, and we have to also highlight that the yield of 2% today is lower than the 5-year of 2.5. So yes, in pure isolation, we would say overvaluation, but as always, we don't solely look at these indicators. We have the blue tunnel, which is great to see increasing over the last year, which as always highlights the intrinsic price, but right now we're seeing this above even the higher end, so again another potential overvaluation signal. Something when we zoom out to the last 5 years, there was actually some periods of time where you could have bought this severely undervalued, which is why we always say make sure you subscribe and have notification bell on. When we get high quality companies severely undervalued, we will make you aware. Now, their growth isn't looking the greatest at a D+. Last year they grew top line at 2%, which was below quite some distance the sector and their own historical double digit 10%. This year, a little bit better at 5.4, but still anticipated to be below the sector at 6.9. Earnings per share, 8%. Now, it is below the sector, but actually we have to say historically they've been growing their EPS around 3.5% year on year. So maybe not something too glamorous and something you wouldn't associate with a company where multiples are expected to expand. And over the next 4 quarters, they're only projecting 2 of them to be growth, but they do have a 100% historical track record. Very sizable beats at that too. And if they can hit that 2026 EPS target forward P will drop to just below 15. Now, institutions, they hold 72% of this company, selling 33 billion in just the last year. They've bought nearly 3 times as much at 87 billion, and actually they did a huge buy in quarter 2, 44 billion versus just under 8 billion selling. Now, if you wanted the reverse of the trend, not a massive distance, but you can see that in Q2 2024. Otherwise, more often than not, institutions continue to be net buyers. And our intrinsic value today comes to $280, where we typically do run through each model a bit of a deeper dive, inputs and outputs. We're going through a few today, so we will stick to the high level approach, 280, which tells us off the bat, given the current price sits above at 301, you are paying a 8% premium if you're adding to your portfolio today. Now, as always, we like to have a minimum 10% margin of safety where we execute if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at $252, then as we keep going, 20%, 224, and at 25, 210. So an 8% premium for JPMorgan, not the best growth rate, so you do have to kind of believe in the words of what Tom Lee is saying over the next year or two. And in terms of Wall Street, they see this $310 into next year, only 3% upside. That was with a fairly weak buy rating. One thing that's also interesting that we will comment on is that when we look at his ETF, GRNY, we did not note JP Morgan. In our opinion, though, this isn't one we would say is a strong buy now, but give us your thoughts whether you see JPM as a buy, hold, or avoid. Before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox covering severely undervalued stocks as well as what's gone on the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a recently released copy of stocks that are severely undervalued in the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year, and a spreadsheet covering 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the other company that he did mention, which is Goldman Sachs, another one which continues to have very strong earnings, and we also note likewise they're expanding into the blockchain. Now this one, very similar, performing very well, up 46% just in the last 12 months. Over the last 10 years, this is one that has outperformed the S&P, very similar to JP Morgan, and they're also trading pretty much around the 52-week high. Now we get a triple hold right across the board from Seeking Alpha, Wall Street and Quant, and we notice another similar scenario, forward P15 well above the 5-year average of 10.5, yield of 2.2 below historical 2.4, so overvaluation potentially, and this is something that's also signaled when we look at the blue tunnel. Yes, intrinsically it is getting more and more as time progresses, but it looks like the market may be getting slightly carried away. A lot of disparity between current value and the upper end. Over the last 5 years though, you can see more often than not, at least from 2020 to 2024, this one was trading in a reasonable signal. Now growth does look a little bit better than JPM. We get a B+. Year on year, 12% revenue was up, expecting 9% this year, which is above the sector on both accounts, and also they're growing faster than they have done historically, not something we saw from JPM. In terms of EPS, also very promising, 14% projected over the next 3 to 5, above the sector and their historical around the 10 mark. But nonetheless, they only anticipate 2 of the next 4 quarters to be growth. Likewise, very, very strong historical earnings, 100% track record. We're talking some significant beats, and if they can hit their EPS estimate, then forward P drops next year to below 14. Institutions themselves, with their 71% ownership, selling 16 billion, they bought around 3 times as much, large amount of buying in Q2, so clearly very, very bullish, and the reverse of the trend, you'd have to go to Q2 2024. So Goldman Sachs, definitely one of institutions like quite obviously, and our intrinsic value gets to $877, which interestingly, unlike JPM where we saw an 8% premium, you're actually getting a 15% margin of safety. Wall Street though, they see it right now pretty much trading at its fair price, hence why we saw the triple hold rating. If you want this at a 20% MOS, then a buy around $700, at 25 around $658. So at a first glance, it looks like Goldman Sachs may be one that is slightly better in terms of an MOS in comparison to JPM, but maybe not sufficient margin of safety to consider as of today. On both accounts though, JPM as well as Goldman Sachs, both of them looking like Wall Street see very, very minimal upside, if in fact any. Now we'll cover a couple of more stocks that will have some effect to the degree of what Tom Lee was mentioning. The first one, SoFi, humongous run up in the last year, 218%, and it's also trading very near 52-week high. We get just one buy rating from Seeking Alpha at 3.76, and we can see their valuation is very, very high. Now you would expect this given it is a strong growth company, but even when we factor in the price to earnings growth, it's coming at just over 3, which is higher than the sector at 1.24, and as a bit of a rule, we typically wouldn't really consider companies that are over the 2 mark. Having said that, growth does look very strong. We're talking A+, grew revenue last year 29%, expected this year at 26%, and whilst it is above the sector median, we can note historically they were growing revenue a little bit faster. EBITDA growth looking very strong, 48%, but the conclusion is the same, faster than the sector but slower than the historical. Earnings per share projected 26% moving forwards, much higher than the sector at 11%. They also project 3 of the next 4 quarters to be growth, and in fact in each of those strong double digit, 100% historical track record, and actually if they hit their earnings per share for 2026, the forward PE does lower quite some way to just below 47, and it's also one institutions like with their 38% ownership. Yes, they sold 1.3 billion, they've bought more than 50% more, and they bought quite a considerable amount more in quarter 2, so institutions have, at least in this recent quarter, been net buyers. And our intrinsic value gets to $24, which just derived from the DCF model, we can show you we have the growth rate 15%, but we've used 2025 as the projected future free cash flow by management. Now as you can see, we have 3 different growth rates, low, medium and high, 10, 15, 20. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below. 15% with the discount rate, we get the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us $24, actually indicating downside of 6%. Ultimately, we can see the current price is reflective of 15.6% growth to the future free cash flows year on year, so you need to believe it should be higher to really see undervaluation after it has run up quite significantly. At 20% though, for those that want to see, and for transparency, $34, indicating 33% upside. So using the 15% growth rate moving forwards, you are paying a premium, although fairly small, at around 5%. If you're someone that wants this at a 10% MOS, a buy at $22. If you wanted higher at 20, we're talking $19.50. And finally, 25 around the $18 mark. Wall Street themselves, they see this around $25 over the next year, so we're talking no upside, in fact small downside of 2%. As we have typically done, so we'll keep it in for consistency, for those that believe SoFi will at one point in time, where it's the short to medium term, equal that market cap of PayPal, then we're talking a 116% upside. That would take SoFi to $55. As always, give us your thoughts, SoFi, if you see it now, after the run up as a buy, hold or avoid. We then move on to Bank of America, another one, pretty much a common theme. This industry has had some strong earnings, at least in the short to medium term. They're also looking into stable coins, they're looking into the blockchain, and the company, very impressive, 26% in the last year. Over the last 10 years, another outperformer, trading at 52-week highs. We actually get not only a double buy from Seeking Alpha and Wall Street, but Wall Street's 4.4 very near 4.5 to flip them for the first time today that we've seen into a strong buy rating. And you could also argue the forward P 12.8 isn't too dissimilar from the 5-year average, so this would be potentially a reasonable signal. Yield not too dissimilar either, slightly lower at 2.2 versus 2.5. And we actually get our first reasonable valuation signal, although it is sitting right there at the upper end. We do note though, during Liberation Day, this one slipped into severe undervaluation, where it was trading in the mid to upper 30s. Over the last 5 years though, this one has given ample opportunity to load up, but we also note the intrinsic price has been going up as well as down. Now their growth at B-, nothing too glamorous. We're talking 4% last year, projected 5% this year. On both accounts, below the sector comparative, but actually they're growing very slightly higher than their historical average. Earnings per share though, this is what we're seeing with quite a few of these banks. Very strong, 14% with the sector at 10, but also above by quite some way their historical 7 to 8% point. Is also the first one today. Not only are we seeing green right across the board, but actually over the next 4 quarters, they're projecting each one to be double-digit growth, and based on next EPS estimate, the forward P projected to drop to just below 12. Now, institutions with their 71% ownership, they've actually sold a little bit more, 31 billion versus 29 billion buying, but in the most recent quarter, we have seen more than twice as much buying. So they are net buyers, at least in the shorter term, and our intrinsic value gets to just below $60. Now that straight away means you are getting a margin of safety of around 15%. If you wanted 20, we're talking $48. At 25, we're talking 45. Wall Street, even with their near strong buy rating, see this into 2026 at $54, 6% upside. Again, nothing too high at all. Give us your thoughts though, whether you agree with Tom Lee. Is this one of those areas that you believe will have a lot of upside into the next 2 years? A little bit questionable. We don't see any of these names that he's mentioned in his top 10 holdings, but perhaps this is something he will add very soon. As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.